Today, I'm excited to talk to you about waterfalls. Not waterfalls like in the forest or Niagara Falls, but real estate waterfalls. These used to be super confusing for me when I started in real estate investing. And because I didn't get a master's in real estate development or spend many years at a large real estate investment group before I started real estate investing as an entrepreneur, I was a little clueless. And of course, I started a long time ago, well before we had ChatGPT or Perplexity.ai to kind of walk us through what the answer was. So even though you've got those AI tools at your fingertips now, I'm going to walk you through a basic waterfall. So if you're starting to raise capital from friends, family, or investors for your real estate investments, you'll kind of know how these work as a general rule of thumb. And then you can get more advanced with different ways of going through that and going to our more advanced video, which you'll see later on more sophisticated waterfalls. Let me first start with the basic model. In commercial real estate, just like residential real estate, oftentimes properties are bought with debt and equity. Debt is synonymous with what's popularly referred to as a mortgage. So getting a first mortgage, which we'll talk about in more detail later about terminology. So for now, I'll use the general term, although from a security perspective, it's not exactly correct. Just bear with me if you know those nuances. So most people are going to go to buy a property. Let's just say we're buying a $1 million property and we're going to get a 70% mortgage or 70% loan to value mortgage on the purchase price of $1 million. That means we've got $700,000 coming from a lender. And now we need to have the $300,000 equity from somewhere else. In addition to the $300,000 of equity on top of the mortgage for the purchase of the property, we also will have closing costs such as title insurance, escrow fees, due diligence, etc. And oftentimes we're going to do something to the property right after we buy it. So we're going to have repairs or capital improvements. And so we'll have even more than 100% of the purchase price as the total capitalization of the property. So again, on $1 million property we're purchasing, getting a 70% loan to value mortgage from a lender, that leaves $300,000 left over for equity that we need to put into the deal and any additional repairs or things we want to do after closing, and of course, addition to closing costs. So now the question is, well, how do most people do this, particularly if you don't have 300,000 laying around? And later we'll talk about you may need 3 million or 30 million to do more real estate deals. But let's start with this basic example of $1 million purchase price. What a lot of people do when they're starting out in real estate is they go to friends and family. And so what they do is they go to friends and family, others who are working or successful. Sometimes it's parents, grandparents, can be a rich uncle. And they say, you can participate with me in this real estate investment and I'll do all the hard work. I'll find the property. I'll underwrite the property. I'll oversee the property. I'll manage everything. You won't get phone calls as an investor in the middle of the night or on a holiday weekend if there's a break in a plumbing line or there's a tree that falls in the yard or whatever the case is. And so as a passive investor, friends and family will say, I'm happy to invest some portion of the 300,000 because you'll probably need multiple investors in this example. And for that, they're expecting a certain return. So we're going to talk about how do you calculate their return. Now, first of all, let's just take this $1 million property that we purchased, 700,000 debt, 300,000 from friends and family as equity, and then some closing costs. So let's say we raised 350,000, the 50,000 on top of the 300,000 for closing costs. And let's say this property is in great condition, so we don't need to do much renovations or improvements to get the cash flow we're expecting. So we go to friends and family and we say, look, we're going to be the sponsor of this property, and we're going to get the property underwritten, make sure it's a good property, do the due diligence, check all the details from crime statistics to rental comparison rates to unemployment in the area, job growth, etc. We're going to do all that due diligence. We'll talk later how we do that with AI, and it's not only more efficient from a time perspective, but more effective from a data perspective. in a later video. For now, let's say your friends and family are comfortable that you're going to do proper due diligence on this great property and it's going to provide good cash flow. And so, for simplicity's sake, I'm just going to say this $1 million property is going to have a net operating income after expenses of $100,000 a year when you buy it. Now, that's a little bit high, but for simplicity, the math will work out easier. So, your friends and family say, great, we'll invest $350,000 of cash. It can be from their retirement accounts, can be from their savings accounts. They could sell stocks and bonds and give you the cash to put into the real estate. However they do it, they come into a deal with you. And typically the deal is memorialized in a partnership agreement. If you're using a LLC, limited liability company, to own the property, which is a great idea, what you want to do is then create an operating agreement for the LLC that specifies who gets paid in what order, how everything works from capital calls to allocation of depreciation. And you want to work with an attorney that's very familiar with real estate operating agreements, or if you use a partnership like a limited partnership or limited liability partnership, you'll create a partnership agreement. But you want to work with an attorney that's very familiar with real estate deals and how these work so that there's nothing left out of the document. If in doubt, when you get your document from your attorney, you can upload it to ChatGPT or Claude or Grok or one of the other LLM models and check it and just ask the AI, is this comprehensive enough and thorough, or are there things that I'm missing? You can even work with the LLMs to say, what are 5 things that could be missing from this document I should ask my attorney about? So you can use the LLMs as a thought partner. But let's say you've got a great operating agreement, everything's in there, or partnership agreement, and now you're going to send it on to grandma, uncle, your friend from college, whomever, so that they can see how the economics will work of this deal. So again, you're investing in a $1 million property. You've got $50,000 extra for closing costs and any minor improvements when you purchase the property. And your lender is going to give you the $700,000 first mortgage, and you're going to bring in this $300,000 equity plus the $50,000 closing costs. And so now what happens to that $100,000 a year? Well, first and foremost, you've got to make sure your operating expenses are in line with your projections so you actually generate $100,000 of net operating income and not overspend on your operations. And therefore, instead of producing $100,000 of net operating income, it goes down to $90,000 or $80,000 or $70,000. That's a real problem, which is why underwriting and forecasting are really critical when you're a real estate investor. So let's say you are successful in your underwriting and your due diligence and your analysis, and the property first year does produce $100,000 of net operating income. Where does that cash go? Again, first and foremost, it's got to pay debt service to your lender, because the lender has the most senior position in the capital stack other than property taxes. You've got to make sure the lender gets paid. And of course, most lenders are paid monthly. For this simple model, we'll just say that they're paid monthly payments on a 30-year amortized mortgage, and it's just consistent principal and interest every single month. And you may even be escrowing your property taxes and insurance with the lender so that they're comfortable that the property taxes and insurance are being paid regularly. And so out of your $100,000, you're spending a certain dollar amount of that every year for the payments. And let's say that's $70,000 of the $100,000 goes to the lender every year. Now, these numbers are not exact in a certain point in time based on interest rate fluctuation and amortization, but I'm using simplified math just to illustrate the point. So please bear with me if you're already ahead in the math calculation here. So the $100,000 of net operating income is reduced by the $70,000 you have to pay for your $700,000 mortgage, both paying principal and interest. And so you have $30,000 left over. Now, it's always wise to have some amount of money in reserves. Reserves are basically like a savings account in real estate. And so if future air conditioner goes out, a roof is worn out, a boiler system or water heater wears out, you have cash in your savings account, again, referred to as reserves in real estate investment, and you don't have to go ask your friends and family or yourself for money to make a repair that's a substantial item. And so you've got reserves. So let's say out of your 30,000 left over after you pay your lender from the $100,000 net operating income, you save 10,000 a year. And while that's probably kind of high, it'll be just simpler to use that math. And so you've got 20,000 of free funds from operations left over. Sometimes in REITs, real estate investment trusts, you'll see them report FFO, free funds from operations. And that's really cash. How much cash do you have left over to actually distribute to your investors? Let's say in this simple model, you distributed all of the cash that's left over after your reserves and paying your lender. So you're distributing $20,000 to your friends and family. And how much did they invest? They invested $350,000 for their part of this investment. And let's just say you're not taking cash out. They're getting all cash up to a certain amount. And so what they'll get is 20,000. And if you want to figure out their return on investment, you would divide the 20,000 as the numerator by the denominator of 350,000. And you calculate what they got as their return on investment that first year. And this is referred to as a cash on cash return, because the cash out was 350,000 that they invested, and that's in the denominator. And the cash in that they got after the first year is 20,000. And so we can talk later in future videos about IRR or an Excel XIRR and how that 20,000 matters when they get it, because there's a concept called time value of money that we want to be aware of, particularly as we scale from smaller real estate investments into large commercial real estate investments. That's going to really be material. But for now, we take our 20,000 that we pay out at the end of the year to friends and family, divided by their 350,000 that they invested with us, and that's their return on investment. But that's not their total return on investment. That's just their cash on cash return. Because what happens on this $1 million property is that it appreciates. I didn't say that right. What happens on this $1 million property is that it appreciates each year. So the value inflates just as GDP grows and things get more expensive over time. Real estate's the same. And it's pretty conservative to say over the long haul, seeing your real estate increase, if you're in a decent demographic market, you're not in a shrinking town population wise, or you don't have negative job growth, and you're in just a stable market and not an amazing market, you'll see a lot of people say, look, this is going to grow by 3% a year, meaning your $1 million investment will be worth $1,030,000 after the first year. But let's think about that. Without taking into consideration closing costs and disposition costs, you just got an additional 30,000 of value from appreciation, and your entire first year's cash profit was 20,000. So you literally made more on appreciation the first year than you distributed in cash profits. This is really exciting, because if you're the investors, you're not only getting your 20,000 divided by 350,000 return the first year, you also get some percentage of that $30,000 first year appreciation. And that appreciation is going to compound on itself and grow year after year after year. So even if it's always 3%, it's 3% on a higher number every year. So the first year it's 3% on $1 million. The next year it's 3% on $1,030,000. The next year it's going to be 3% on the higher amount. So that compounding is where a lot of people get wealthy with real estate. It's certainly great and important to have a cash on cash return. But when you're talking about waterfalls and how do I share the cash flow profits and the appreciation profits with an investor, you've got to take into consideration both items, cash flow and appreciation. So let's say we fast forward 10 years. We buy this $1 million asset. We hold it for 10 years. We've been cash flowing every year. Let's say we've even given all the cash flow after accounting for reserves and paying down the mortgage to our investors that put in the $350,000. They've made a really good return after 10 years. In fact, 20,000, if it doesn't grow, which it should, times 10, they've gotten $200,000 back if it's just stable on their $350,000. And that's just profit. or return on their investment. They still need their investment back, their $350,000, which they're going to get when we sell or potentially refinance the property. But now let's say it's 10 years later and we go to sell the property, and there's going to be closing costs like listing agent fees, title and escrow fees, maybe even a prepayment penalty on the mortgage if it's not a residential property, things like that. But let's say we go forward and this property, because of market dynamics and everything else, it's now going to sell for $1.5 million. Now, 1.5 might be a lot, it might be low. Things happen over 10 years that sometimes are totally out of your control. Like there might be a large influx of population that makes housing more attractive, or there might have been a legal change where it takes longer for developers to build apartments, therefore there's more demand for your apartments, or things could go in the opposite direction and it doesn't increase as much because there's oversupply of apartments. But let's just take this simple example to see how it would work out. So after 10 years, you decide as the sponsor to sell the property for $1.5 million. And let's say all of your closing costs to sell are $100,000. So you're really getting a $1.4 million net proceeds from closing when you sell the property. Now, where did the $1.4 million go? For simplicity, I'm just going to say we're paying back the lender. The first lender was $700,000. We may have paid them down a little bit because we were paying principal and interest per month. So let's just say that the $700,000 mortgage is now down to $675,000. So out of the $1.4 million of proceeds, the first $675,000 goes to the lender to have them release the mortgage and go away. So now you're left with the remaining balance, 1.4 minus 675,000. Now the first thing you do in almost all deals in real estate is you pay your investors back the 350,000 that they originally put in the deal. That's their principal. They get that back next. And so you've taken the 1.4 million of proceeds after closing costs, you've paid back the lender 675,000, and you pay back your friends, family, etc., the 350,000, and now you've got a certain amount of cash left over. And here's where it gets really interesting from a sponsor perspective. The question is, how do we allocate those monies? In a lot of friends and family deals and residential deals, those are often allocated 50-50, meaning the leftover cash after the investor gets their capital back is split 50% to the sponsor and 50% to friends and family. Now, in this deal, they're going to be pretty happy because they got that 20,000 or more every year for 10 years. They also are getting 50% of these net proceeds. And later, we'll talk about a whole episode on depreciation. They also got tax benefits from being a partner with you in this investment. So they're pretty happy. And you ended up making your amount of money from successfully overseeing this property, handling issues with property management, releasing it, dealing with any broken repairs and maintenance issues, and obviously making sure to sell it at the right time. And so this becomes pretty lucrative for sponsors, particularly when you don't just do one deal over 10 years, you do multiple deals. And really, I'll film an episode on this later, but there's this methodology that I teach whenever I talk at universities, whether it's an MBA program or an entrepreneurship program. I'll always give this nugget to students. And so far, no one has taken me up on the offer. But here's how it works. If you invest in one residential property every year for 10 years, you will be financially free for the rest of your life. Now, let that sink in. This can work for college students. This can work for retirees. But essentially, if you invest methodically, consistently, using the 1% rule we've talked about in prior videos, you can be financially free in just 10 short years. This example of taking one property that we bought for $1 million and selling it later for a gross value of 1.5 million gives you several hundred thousands of dollars, but it's not going to make you financially free. You've got to do multiple investments to get there. But this waterfall, again, in this simple friends and family, small residential investment, split 50-50 on the profits. And by the way, in addition to your investors getting $20,000 a year of cash flow, you are likely getting a property management and potentially an asset management fee for overseeing the investment, which is fair because you're doing the work, taking the phone calls, handling the issues when they come up, And most of your investors are going to be totally fine with that, because the last thing they want to do is start taking phone calls from tenants, worrying about releasing, fixing a toilet that breaks down, worrying about the property manager on vacation, et cetera, et cetera. So you will have to put in the work for your hundreds of thousands of dollars of profit, but it's well worth it, especially if you do multiple investments over time. We'll talk about in future episodes how this simple model of cash to investors and splitting the profits can be amplified when you've got more sophisticated waterfalls. But this basic structure of how to raise money from friends and family and distribute is something we want to start with as a fundamental baseline, because with this foundation, we can do lots of cool things, making sure your investors are happy and profitable and successful, and you as a sponsor continue to make more and more money as you grow your portfolio and your expertise. I'll film those videos in a bit and share them soon. Hope this was helpful. Bye for now.